Hello and welcome to learning objective number 2, identifying the major differences and similarities between financial and managerial accounting. In this mini lecture video, we will be identifying and discussing the major differences and similarities between the two. So while both of managerial and financial accounting come from accounting being the language of business, according to Warren Buffett, accounting being the recording, estimating, organizing, summarizing, essentially coding financial information into financial data into financial information. These are looking at financial and operational data. All of this is accounting. However, as you likely looked at last term, financial accounting makes financial statements, they provide financial information, they'll do things like create balance sheets or statements of financial position, income statements or statement of financial operations. They'll look at cash flow statements, they'll look at a statement of shareholders' equity and whatnot. However, in managerial accounting, you're going to be looking at information to make management decisions, as we saw in the last video. Items for planning and control, helping to motivate employees internally, as well as the information that is set from the strategy being how do we identify our customers, how do we serve them, what is our customer value proposition. Okay, so let's look at some examples to compare and contrast the two. Our users for financial accounting are external, for the most part. So they're largely external, people who make financial decisions, people like shareholders, people like our customers. A customer might look at our financials to make sure that we can actually pay for what we're ordering from them. This may be our suppliers. So just like our customers, are we going to be able to provide the service that we said? Are our suppliers, are we going to be able to pay back our suppliers? So suppliers, customers are going to do what we're going to say we're going to be doing, two sides of the same coin. Our shareholders, what are we doing with the money that they invested in us? How are we delivering value back to our shareholders? Our debt holders, so are we actually going to be able to pay back our debt? Whereas internally, the users are typically going to be managers, leaders who plan and control for the organization's success according to their strategy. While financial accounting tends to look backwards to provide the historical perspective on what happened, managers are using this information to plan for the future, to make sure that their decision making, which is forward facing, is going to be putting the company in the best position to meet their strategy. Objectivity and verifiability are the main pillars for financial accounting, whereas relevance is the pillar for management accounting. So whereas there's a standard set of generally accepted accounting principles, GAAP, either IFRS or ASPE if you're Canadian, because the focus is on relevance, there's not actually kind of a managerial accounting framework as set out by regulators. This needs to be precision, of course, based on timelines, but it must be materially accurate, whereas the decision, and I say materially accurate for the quarter, for the year end, according to external deadlines. And then here, it's on timeliness. So they might need, for managers, they'll take a little less precision as long as they know, okay, what is that information for today? How many things should we order? How many things should we produce? How do we ship this to our client according to our contract, etc. Looking at the subject, so who is the subject for external reporting? It's going to be the entire company. There might be one set There might be one session where we break it down a little bit further, but in general, it's a balance sheet for the entire company. It's an income statement for the entire company. It's a cash flow statement for the entire company. Whereas managerial accounting, we're like, okay, cool. Well, who are we providing the information for? What decision are we trying to make? And so we'll crunch the data, provide the reports for that decision that we're trying to make, which is typically going to be for a group or a segment, etc. Who requires this? Well, for financial accounting, if we are publicly listed, it's going to be our regulator. If it's a TSX venture, for example, those reporting deadlines and reporting types are going to be set by the venture. If it's TSX, if it's NASDAQ, etc. However, management accounting, not mandatory. If you don't actually want to do it, you don't have to do it for management accounting. However, why people do it is because it makes the company more money. So while, interestingly enough, financial accounting, if you're working in these functions, it can kind of seem as, oh, you're taking time, you're costing the company money because it's required, but you're not actually seen as providing value. Whereas managerial accounting, like you're solving problems. You're like, hey, how can we do the same thing faster or cheaper? Or hey, how can we use the same resources and get more money? So either way, you're kind of adding to the business function when you're looking at managerial accounting. So in real life, pragmatically, people tend, if you go into accounting, you tend to prefer one or the other. And even if you aren't planning on going to accounting, you tend to prefer one or the other. They are quite different. However, I will let you in on a secret. For myself, I focused, even before I was planning on being an accountant, on wanting to know both. Because I want to see, how can I integrate the two? How can I leverage my understanding of one? And understand how it works internally. How can I understand what's required? How can I understand what's going to make the company or save the company money? So I like kind of seeing how one set of data, right? Sorry, I'm just trying to go back. Boop. How one set of data and looking at how it provides two different contexts, two different decision makers information. So I like to look at both, and which is why I teach both. I guess that makes sense. So just in case somebody tells you, oh, you're either going to like one or the other, you're going to be good at one or the other. No, be good at both, right? There's no zero-sum game here. If you got an A or an A plus or A minus or whatever you got in the last class, you can get the same here. Similarly, if you, didn't do too well or didn't meet your definition of success in the last accounting, don't think that this will come easy, right? This is going to be, maybe you'll enjoy it more, which I hope you enjoy it. But this stuff, like anything else, just takes some work and takes some patience and takes some application. So when we say that looking at managerial accounting, you look internally and you look at how do we make the company money? So how do we either grow the revenues or shrink the expenses or do both? We look at the value chain. So how are we researching, developing this item? What does the product or service look like? How do we make it? Are we making it in-house? How are we marketing it? How are we letting people know what is available? How are we going to get it to them? And how are we going to follow up with our customers? So if we are, for example, Peloton, how are we going to make I would say that is definitely going for product excellence. And possibly a little service excellence, but I've never heard people raving around Peloton service. I've heard about them loving the product including the online personalities like Cody and his Kitten Heels discussion. So how are they going to research? How are they going to develop these bikes that, the resistance moves on its own? There's a giant screen, which was definitely relatively new for bikes that were not only a physical product, but also a software as a service. So you get this sweet revenue one time for the bike, and then you get an ongoing revenue stream. How are we going to manufacture this? How are we going to let people know about Peloton? Are we going to provide ads? Are we going to let it distribute via word of mouth? Are we going to have showrooms in busy, New York and LA? Are we going to get celebrities to talk about how awesome Peloton is? Are we going to do a little bit of everything? How are we going to get the bikes to the humans? And how are we going to follow up? So every company almost without fail is going to have most of these elements of the value chain. Even when you talk about service companies, manufacturing might not look like widgets or putting bolts onto bikes, but it might look like how are we designing the process for this service. All right, so my question to you is, and perhaps we covered it a little bit, but I want to reinforce this. Why does managerial accounting not need to follow generally accepted accounting principles, the GAAP? So take a moment, pause this video, and we'll come back in just a second and discuss this. All right, welcome back. So why do managerial accounting professionals, or why does managerial accounting not need to follow GAAP? Why are they not required to cover IFRS or ASPE in their reports? Well, pragmatically speaking, you could say because the regulators don't require them to. Cool, that would be an acceptable answer. You're not listed on the, they don't have to. Managerial accounting isn't regulated. But even going above that, it's like, well, why isn't it regulated? Well, because the users are internal to the company. So just like any other non-regulated function, you're not regulated to use a certain type of paper for toilet paper. You're not required to use a certain type of flooring in a Walmart, so you're not regulated externally because the information is internal. Whereas GAAP, our financial reporting, that is going to be external. So the users are one of the reasons. Time focus, so looking backwards versus looking forwards, as well as the subject matter. Are we providing reports for historical information, or are we looking in managerial accounting for decisions on how to make more money? How are we going to increase the revenues or decrease the expenses? Now, as an aside, I talk about for-profit companies in general as a default. However, you can use these same principles for nonprofit organizations. So nonprofits where their primary goal isn't to make a profit, though they do definitely want to break even. So it means they may have kind of excess revenues over expenses in some years. However, you can use these same principles. They just have a different objective. So in for-profit entities, you generally want to maximize the amount of money and amount of revenues over expenses, the amount of net income earned for your shareholders, either in the short term, the long term, or both. And in nonprofits, you typically want to provide the best service or support to the users of that organization. So managerial accounting applies equally to both. In general, I tend to talk about for-profit entities, just as an FYI. All right, so thank you so much for your attention. I will see you in the next video.